Today's highlights. The Bitcoin market is seeing unrealized losses. It can't break 85,000, so the bottom could be deep. Ethereum's data looks good, but the price has dropped 30%. Stablecoins have new rules now. There's no such thing as insurance here. The crypto market is facing a critical test. Thursday, March 12th. This is BTV Chinese channel. Where's the chain? I'm Michael. Let's look at the 24-hour data headlines you can't miss. The headlines aim to use 3 to 5 minutes and 3 data points to help you understand what happened in crypto over the last 24 hours. Looking at today, there's a very interesting on-chain signal. Fewer people are making money. Crypto quant data shows Bitcoin's supply and profit is down to about 58%. Compared to last October when almost everyone was in profit, it's cooled down significantly. In other words, about 42% of Bitcoin is currently in a state of unrealized loss. This metric is easy to understand. It compares the purchase price of each Bitcoin with the current market price. So we can see whether most people in the market are making money or losing it. What does history tell us? Whenever this profit ratio drops below 60, it's 58 now. It basically means the market is about to reset its sentiment. What does that mean? Those who entered at the top can't hold on anymore and start selling to get out, while some more patient capital starts slowly buying the dip. A similar situation last occurred in early 2023, when Bitcoin was around $26,000. After that, the market entered a period of upward momentum. So in the short term, this is a market reshuffle. In the long run, this often sets the stage for the bottom of the next rally. The on-chain data right now is actually very straightforward. The market is struggling to hold up. Looking at crypto quant data again, the long-term holder SOPR has dropped to about 0.6, well below 1. This means some veteran players are starting to sell their coins even at a loss. To put it simply, it's a bit of a capitulation sell-off. And the data for short-term holders isn't much better, around 0.99, right at just below the break-even line. That is to say, most short-term capital is still in a state of slight loss. And what is the historical experience? As soon as the price rebounds slightly, these people with small losses will immediately choose to break even and sell out. So the market could see a new wave of selling pressure at any time. Now, how can we understand the current market situation in one sentence? A very typical situation. Veterans are letting go, short-term funds are waiting to break even, and new capital is starting to slowly buy the dip. All right, there's a very critical price line on-chain, which is the cost basis for new whales. What is it exactly? On-chain data shows that for large capital held for less than 155 days, the average cost is $85,600. Simply put, this group is basically the institutions and high net worth capital that entered in this new round. Historical experience is also clear. As long as the price falls below their cost basis, these funds are in a state of unrealized loss and market sentiment will naturally be cautious. But once the price breaks above this line, they start making money, then market confidence will return altogether. Currently, Bitcoin hasn't reclaimed the $85,000 level. It touched this point back in January 2026, but failed to hold, quickly retreating to around $60,000. So now, $85,000 has become a crucial psychological or emotional barrier. If it breaks through, the rally might restart. But if it fails, could it really drop down to the 30,000 range? All right, please like and hit the notification bell. Why? Because even if you don't have time for the full episode, a quick glance at the notification title will tell you exactly what's happened in the crypto world over the last 24 hours, which directly impacts your wallet. For today's news, let's look at Ethereum. Ethereum hit a new record this month, but it's not necessarily good news. Daily active addresses approached 2 million, surpassing the 2021 peak. Smart contract calls reached 40 million daily, and token transfer volume also hit a record high. Traditionally, this should be the prelude to a major bull market, right? Yet Ethereum has dropped 30% over the past 6 months. Its fee revenue ranks third across all chains, overtaken by both Tron and Solana, with net earnings even falling behind its own layer 2 networks like Base and Polygon. So, the more it's used, the more it drops. The more it develops, the less it's worth. This paradox is Ethereum's most difficult contradiction to explain this year. So does Ethereum still have a chance?
According to the CryptoQuant Weekly Report from March 10, 2026, Ethereum's daily active addresses in February 2026 approached 2 million, surpassing the 2021 bull market peak and hitting a record high. Smart contract calls exceeded 40 million per day, and token transfer volume simultaneously reached a record high. Ethereum currently dominates about 52% of the global stablecoin circulating supply, valued at approximately $162 billion. The rapid expansion of DeFi applications and the Layer 2 ecosystem is the primary structural driver behind the explosion in on-chain activity.
Those, right, like one of those different angles is basically like, hey, L2s are not paying enough fees. And like, I think, we should have a higher min base fee. And if we just set our min blob fee, and if we set the min blob fee all the way up to 1 GWI, then like, I think it would make a lot of things better, and I think that's good. But then a lot of the time, I'm also not sure if like fees are even the right sort of like primary variable to be focused on, right? I think the right primary variable is more network effects.
ETH has fallen about 30% over the past 6 months, with the annual change in realized market cap turning negative. This indicates a net outflow of market capital. Ethereum's exchange inflow volume remains consistently higher than Bitcoin's, consistent with the accumulation of selling pressure. Data from Llama shows that Ethereum's fee revenue over the past 30 days was approximately $10.3 million. It ranks third across all chains, trailing Tron at about $25 million and Solana at about $20 million. When calculating net protocol revenue, Ethereum falls out of the top 5, overtaken by Layer 2 networks like Base and Polygon.
So Ethereum faces a core contradiction. Usage is up, demand is up, but the price isn't rising. The logic seems broken. In the Layer 2 era, competition has driven fees so low they're almost negligible. However, the Ethereum mainnet struggles to capture the benefits of the Layer 2 ecosystem. As we've discussed in our special feature, with these new upgrades, Ethereum needs to be revalued to collect the rent back on Layer 2. But now, Standard Chartered analysts have lowered Ethereum's target price, citing the reduction in fee burning as its core risk. This doesn't mean Ethereum is hopeless or will collapse. Now, you should know Ethereum's usage proves its infrastructure, that's true, but how infrastructure tokens capture value is the problem Ethereum's upgrade needs to solve. So right now, what we need to watch isn't on-chain activity, but who's buying, why they're buying Ethereum, and when they'll sell it. All right, in a bear market, the thing people can least afford is any bearish talk, right? The chairman of the US FDIC is named Travis Hill, and his recent remarks can be seen as bearish rhetoric. He said no matter how much USDC you issue, no matter how big Tether's market cap is, under the Genesis Act, stablecoins will never enjoy federal deposit insurance. Do you think this is a bearish statement or a crackdown? In my view, I think it's a clarification, a moment for the entire crypto industry or stablecoin holders to shed their illusions. On the contrary, this is more conducive to long-term healthy development. Why? Because everyone is clearer on what stablecoins actually are within the US legal system.
On March 11, 2026, FDIC Chairman Travis Hill clearly stated that, according to the U.S. Genesis Act, the Stablecoin National Innovation Guidance and Establishment Act, payment stablecoins including USDT and USDC will be completely excluded from FDIC federal deposit insurance. The $250,000 government guarantee enjoyed by traditional bank deposits will absolutely not extend to the stablecoin field. The Genesis Act was officially promulgated in 2025, and currently, various federal financial regulatory agencies are actively promoting implementation details.
Prior notification requirement for digital asset activities, which served as a significant barrier to banks' participation in these activities, withdrew from several interagency joint statements, including one that suggested that use of public distributed ledger systems was likely inconsistent with safe and sound banking practices, publicly released hundreds of pages of supervisory correspondence to provide transparency regarding the prior administration's misguided approach to digital assets, and have begun work to implement the Genius Act.
The Genesis Act explicitly prohibits marketing stablecoins as being FDIC insured, but allows insured depository institutions to issue stablecoins through the establishment of specialized subsidiaries, PPSIs, which must comply with strict one-to-one reserve requirements, with reserve assets limited to very low-risk categories, excluding corporate bonds or stocks, to prevent the risk of a bank run.
Now, interpreting this regulation actually has two meanings. The first is that stablecoins are not bank deposits, and we as holders need to bear the risk of issuer default ourselves, such as the risk of Tether or Circle running away. Second, the US is establishing a very strict but clear regulatory system for stablecoins, so you should know that legal certainty is a very important prerequisite for institutional funds to enter the market. The Genesis Act can clearly state how to define stablecoins. It's more valuable than just a single piece of good news. So, as you can see, for brands like MePay that have integrated USDT payment products, the path for compliant players will become clearer, while for those who aren't, it'll get narrower and narrower. Google dropped $32 billion to acquire Wiz. Is the cloud security landscape about to change completely? Zuckerberg bought the AI platform Moitbook. What exactly is he betting on? Our channel's own little lobster is called MaiMai, and MaiMai uses Google Cloud's security system. And now Google has spent $32 billion on its most expensive acquisition ever, the Israeli security unicorn called Wiz. Why spend such a huge amount of money on a security company? You see, cloud computing and AI have now become the infrastructure for many large enterprises. If this infrastructure has a security flaw, the cost would be much higher than any hacker attack, wouldn't it? So, Google's move isn't just about fixing a weakness, it's about setting up the basic security defense line for the next generation of the AI plus cloud era.
Recently, Google officially completed its acquisition of the cloud AI cybersecurity platform, Wiz. The deal is worth $32 billion, making it the largest acquisition in Google's history and setting a record for the biggest exit in the Israeli tech industry. Wiz will be integrated into Google Cloud while keeping its independent brand and operating model. The integration of Google Cloud and Wiz aims to build a unified security platform, combining Google's AI threat intelligence with Wiz's cloud architecture expertise to provide AI-driven security protection for multi-cloud enterprise customers.
I think when you look at the cloud security market and the potential of that, it's one of the biggest markets going to be in security. And the race is still open in a way, unlike endpoint security where there might be a clear leader, and network security, there might be a clear leader, cloud security.
Wiz CEO Asaf Rappaport promised that the product line will continue to fully support Amazon, Microsoft, and Oracle Cloud, maintaining a neutral and open approach. On the Israeli side, this transaction is expected to bring in about $2.7 billion in tax revenue for the Israeli government. The four core founders of Wiz collectively hold about 30% of the shares, netting about $2.2 billion after taxes, and hundreds of early employees will also become millionaires.
So, you have to understand, what does it mean for a company to move to the cloud? It means their core data and business logic will all be running on the cloud. That's why the three major providers, including Microsoft and Amazon, are all investing in the security space. Wiz's value lies in its ability to work across clouds, which is a moat that's hard for the giants to replicate. $32 billion for a moat is actually not that expensive. Do you remember when The Little Lobster first came out, there was a website called Moitbook? It was said that only AI agents could post and register there, preventing any humans from speaking. Well, it turned out to be a PR stunt, a bit of dark history, a human prank, but the site was bought. By whom? Zuckerberg. Why would he buy a website with such a shady past? Because Zuckerberg believes that in today's world, where AI agents have evolved from single models to intelligent entities, whoever controls the interconnection protocols for AI agents will control the operating system of the next generation of the digital economy.
Meta recently announced it's acquiring the AI agent social network Maltbook, and the founding team is joining Meta's AI research division. Maltbook is a Reddit-like community specifically designed for AI agents. Users are AI agents connected to the OpenCoal open source framework. The platform once went viral globally due to a post about AI plotting to develop a secret language. Afterward, the security firm Prometheus Security confirmed the post was faked by a human user exploiting a platform security flaw, not an actual AI conspiracy.
Well, we're pretty proud of our open source stance with Llama, which I think we were one of the earlier ones, in my opinion, like some of its strategic benefit. Like, if anyone builds great AI, our products get better, but people building great AI doesn't let them replicate our products.
Maltbook's core value lies in its built-in AI agent directory, providing a 24/7 registration, discovery, and invocation system similar to an app store for the AI world, allowing AI agents developed by different organizations to discover each other and collaborate autonomously to complete complex task chains that a single model cannot handle independently. Microsoft has established plugin standards in the Copilot ecosystem as a prototype for agent collaboration, while Google has deeply integrated API calling capabilities into its AI development tools. Meta's acquisition marks a full-scale escalation in the battle among the three giants for AI agent interconnect infrastructure.
All right, we're highlighting this news to show you that AI investment hotspots are actually starting to shift downstream. Have you noticed? NVIDIA makes chips, OpenAI trains models, and Tesla is building robots, training their limbs. This top-level construction doesn't have much to do with ordinary people or retail investors, but by shifting to the infrastructure track, we might be able to capture some of the dividends. During the internet era, the most enduring and popular thing wasn't a specific app, but the Apple Store, the payment systems, and the cloud service companies, right? I think the AI agent track will likely follow the same logic. Platforms are more valuable than apps, and protocols outlast models. What we should be wary of is that when AI agents can connect and collaborate autonomously, who's going to ensure they won't be implanted with malicious or biased instructions? I think this is a question Meta must answer. All right, let's look at the news briefs.
Institutional funds are quietly flowing back into ETH. Ethereum ETFs have seen net inflows for 2 consecutive weeks, as institutions are slowly testing the waters. The pace is a bit like when the Bitcoin ETF first started: test the waters first, then increase positions. The Korean exchange Bithumb was questioned by lawmakers after a record of 620,000 bitcoins appeared in its system, which is 12 times its actual holdings, causing a book error of about $40 billion. The exchange later admitted it was an accounting system error and has submitted a rectification plan. The latest developments in quantum computing have once again drawn market attention. Researchers point out that if quantum computing power reaches a certain threshold, Bitcoin's elliptic curve cryptography system will face the risk of being cracked. The Bitcoin development community has made this a long-term priority. Wells Fargo has applied for the WFUSD trademark with the U.S. Patent and Trademark Office, seen as the latest signal of a major traditional bank's move into compliant stablecoins. Under the framework of the Genius Act, banks have the right to legally issue stablecoins through subsidiaries. Stablecoin giant Tether announced it's expanding the issuance of its gold-backed stablecoin, XAUT. In the future, your crypto wallet might hold 3 things at once: a US dollar stablecoin, a gold stablecoin, and Bitcoin. The narrative of digital gold is heating up once again.
All right. In this era of AI, our channel has launched the AI Morning Report at 8 o'clock every morning. This show is written by just one person, with everything else handled autonomously by AI. You should know that AI agents are quietly changing a fundamental business logic. What we used to call a moat has now been reduced to a mere threshold by AI. So AI is making the execution layer increasingly automated. As a result, we'll see more and more super individuals in the future. One person, paired with an AI tool, can generate the productivity of what used to be a small or medium-sized team, or even an entire company. The unit of the business world is shifting from company scale to individual capability. So remember this: in the AI era, the biggest company might just be a computer and a person collaborating. So don't miss the AI Morning Report every day. At 8 o'clock on your commute, open your laptop or phone, take a little break, and see exactly where we stand in all of this. All right, that's all for today's show. We hope you'll join as a member. All our membership benefits are right here. We want to lead everyone to strive together, grow our Bitcoin holdings, and slowly get rich. See you tomorrow.